The Chief Financial Officer's Guide to Achieving IFRS 17 Compliance. IFRS 17 is arguably the most significant change to insurance accounting that has ever taken place. The standard requires insurance chief financial officers to produce new financial reporting and will challenge their ability to explain the business clearly to investors, boards, regulators, and other stakeholders. The principles-based standard drives forward-looking estimates onto the balance sheet, placing finance teams under an even brighter audit spotlight, with the need for new controls and governance processes, extensive disclosures, and the ability to substantiate reported results. While initially the focus was on the addition of a new required calculation, the contractual service margin (CSM), insurers and advisors are realizing that correctly calculating the CSM over time is just one aspect of achieving IFRS 17 compliance. Insurance IFRS 17 project teams recognize that the challenge extends well beyond where to home the CSM calculation and are focused on delivering an end-to-end IFRS 17 reporting process. What are finance teams' IFRS accounting requirements? IFRS 17 compliance requires a series of financial accounting changes. First, insurers need to fit their entire book of business into new measurement models to create and apply complex accounting posting rules over hundreds of contract types and product lifecycle events. Second, finance teams need a new IFRS 17 chart of accounts and to produce extensive new disclosures, delivering IFRS 17 accounting quickly within the working day timetables, which for finance teams are more frequent, monthly, and typically more accelerated than other regulatory insurance reporting, such as Solvency II. Finally, finance teams need to manage IFRS 17 transition closely, as new balances will drive profitability for years to come and will be under scrutiny from investors, regulators, and tax authorities. Importantly, IFRS 17 reporting cannot be delivered in isolation, as financial balances are invariably affected by many other GAAP reporting standards, including IFRS 9, IFRS 15, and other rules such as those that dictate the application of fair value. An overview of finance teams' IFRS 17 requirements. Chief Financial Officers are vested with Chief Actuarial Officers to deliver IFRS 17 reporting accurately, on time with controls, and audit ability. Complying with IFRS 17 requires more than delivering contractual service margin calculations. IFRS 17 requires finance teams to harmonize data, processing, and control across the entire systems environment. In a post-IFRS 17 world, Chief Financial Officers will be challenged to clearly explain the business strategy and results, but it offers many obvious opportunities to improve finance teams' capabilities. The challenge of explaining business performance in the post-IFRS 17 world. Chief Executive Officers rely on their Chief Financial Officers and clear financial reporting to explain their business to investors, boards, regulators, and management teams. Many insurers expect IFRS 17 to result in more volatile results, and the new standards may affect the ability of companies to pay dividends and even impact executive bonuses. In the IFRS 17 world, finance teams will have to focus on how all reporting processes across metrics will work together, including for things such as planning and forecasting. For the external audiences, the common language of IFRS 17 will, eventually, reduce variation in reporting practices and place pressure on chief financial officers to quickly and clearly substantiate financial results. Experience adjustments will have to be applied and explained, and accountants will have to understand how profit and loss statement changes can be attributed to changing assumptions such as interest rates. Insurance companies need to deliver comparative reporting starting in 2020, challenging chief financial officers to explain the variations between reporting bases. Consistency of treatment across the business will be under much higher scrutiny, and investors will expect chief financial officers to explain variations across multiple gaps and regulatory reporting regimes. Comparative reporting will challenge chief financial officers for many years to come, with many insurers already hearing from tax authorities that they will want to see results presented using old and new models for up to 7 years, and managers wanting to continue non-IFRS 17 related key performance indicators (KPIs) for employee performance management processes. What we learned with global European and Asian insurers through our first 3 IFRS 17 proof of concepts and hundreds of market interactions. First, most mid-sized and large insurers will need to bridge the gaps between actuarial systems and general ledgers, between CSM engines and accounting, and data integration and calculations. One client had 250 plus source systems, with many holding data in proprietary formats. Second, compliance requires tackling a whole host of detailed accounting requirements, e.g., managing full and delta ledgers, auto-reversing journals, the ability to manage manual adjustments, transition balance management, following the sun to produce IFRS 17 across Asian, European, and American entities, simulation of accounting impact under different scenarios, aligning management information systems well with IFRS 17 financial data, and reconciling existing Solvency II and local GAAP accounting. Third, IFRS 17 brings significant new volumes of accounting. Many firms are recognizing the requirement to store contract or even lower cover level data, but for many insurers, this equates to hundreds of thousands, if not millions, of accounting line items per day. Fourth, finance teams need to run the business in a post-IFRS 17 world, and many are incorporating finance improvements into their projects, including fast close requirements, chart of accounts consolidations, improvement of Solvency II reporting outputs and timetables, reducing manual processing, improving reconciliation cycles, standardizing finance data across business lines, and digitizing or modernizing finance teams' IT architecture. Fifth, coordinating across divisions and geographies will make IFRS 17 compliance more difficult. Many insurance companies have grown through acquisitions with federated business divisions and a single group finance function consolidating results. Several of Aptitude Software's prospects had more than 40 general ledgers. Group-level IFRS 17 project teams will need to define IFRS 17 accounting approaches, unit of account, measurement models, transition methods, using financial accounting hubs to ensure divisions deliver appropriate data and apply accounting policy correctly. Who has got financial control and governance? Those insurance companies that have performed deeper analysis or completed proof of concepts have highlighted the need for finance teams to harmonize data, processing, and controls across actuarial, policy administration, and finance systems to create and manage IFRS 17 portfolios to ultimately produce highly controlled financial results. Expected cash flows sourced from actuarial systems environments will form the basis of most IFRS 17 calculations. A lot of these numbers have been done by actuaries for many years, but insurers will need higher levels of comfort and greater control frameworks around the actuarial data sets. Ownership of these figures is driving actuarial and accounting teams much closer, but ultimately finance team will need to be able to deliver the controls around the end-to-end process. This goes well beyond the CSM calculations. Whereas data for these judgments may source from actuarial, pricing, or policy systems, finance team's role is to manage the end-to-end process to deliver consistent, auditable results with the ability to quickly and clearly explain business performance to all stakeholders. Having the ability to drill down into the provenance and transformation of underlying data will be a key success factor for insurance chief financial officers. Summary of learnings from Aptitude Software's fourth quarter 2017 Global IFRS 17 Readiness Assessment. First, 39% of firms that have started their analysis expect to kick off implementation projects in second quarter 2018. The 8.2% that are already in active implementation phases have an average gross written premium (GWP) of £15.3 billion, approximately $20.4 billion. The average GWP of companies at a pre-impact analysis phase is £6 billion. Second, IFRS 17 is challenging insurers of all types and sizes. It is not just a life insurance issue. It is having a significant impact on smaller regional and non-life insurers. Third, the industry has learned that IFRS 17 requires much more than delivering CSM calculations. Fourth, functionally, chief financial officers are taking the lead on IFRS 17, but working closely with chief actuaries with the goal of harmonizing data, processing, and control across finance and actuarial environments. Fifth, with many insurance companies expected to start implementation in mid-2018, and with project teams consisting of 50+ full-time equivalents, FTEs, a major skills gap is expected. Shifts in thinking. Financial reporting requirements shadow CSM calculation decisions. 84% of firms included in the Aptitude Global IFRS 17 Readiness Assessment cited a disparate actuarial environment, which will be a constraint to delivering consistent calculations, cash flows, discounting, risk adjustments, CSM. Project teams are also grappling with how to capture granular contract data necessary to support the application of IFRS 17 measurement models, how to connect heterogeneous actuarial and finance systems environments, and how to manage the all-important transition balances. 88% of insurance company IFRS 17 project leads highlight that the new processes are needed to support IFRS 17 disclosure requirements. Most insurers cited the need to incorporate parallel reporting requirements, including local statutory reporting standards and the new IFRS 9 accounting rules governing financial instruments. And many respondents expressed the desire to fix or improve Solvency II reporting requirements as part of their IFRS 17 project. How do Chief Financial Officers equip themselves for their IFRS 17 expeditions? It is possibly premature for insurers to seek strategic benefits from their IFRS 17 programs when the routes to compliance are not yet defined. However, when considering how to tackle the standard, it is important for Chief Financial Officers to keep focused on improving, rather than reducing, their ability to explain business performance. With this need in mind, some insurers are already tying their IFRS 17 programs into broader finance improvement initiatives, with insurance Chief Financial Officers wanting to gain a single chart of accounts across their business, support new business models and product lines, deliver cost reductions through reduced manual processing, and build better financial data foundations to drive better insights into the business. For some, these strategic benefits come with an incremental cost, but will provide insurance companies with important capabilities to compete effectively in a post-IFRS 17 world.